The Commerce Department just released numbers that should make every investor excited. The U.S. economy grew 4.3% last quarter, the strongest single-quarter growth in nearly 2 years. The stock market is near all-time highs. Corporate profits are at records. Unemployment is low. The White House is celebrating. CNBC is running victory laps. Your financial advisor is probably telling you to stay fully invested. But Warren Buffett is doing the exact opposite. He's sitting on $381 billion in cash right now. That's not a typo. $381 billion earning almost nothing while the economy is supposedly booming. That's 9 times more cash than he held during the 2008 financial crisis. It's the largest cash position he's ever held in 70 years of investing. Either the 94-year-old man who turned $10,000 into $150 billion is making the biggest mistake of his career, or he sees something the government isn't telling you. And in the next 13 minutes, you're going to see exactly what it is, because your retirement account depends on knowing the difference between what they're saying and what's really happening. Here's the question nobody's asking. If the economy is so strong, why won't the smartest investor who ever lived put his money into it? The answer is brutal. And it starts with understanding that GDP growth and real economic health are not the same thing. Think about your neighbor. Let's call him Mike. Mike just bought an $85,000 Ram TRX on a credit card. 24% interest. Can't actually afford it, but the dealer said yes. The bank said yes, so Mike's driving around in a truck that costs more than he makes in a year. That purchase shows up as economic growth. The dealership reports higher revenue. The bank reports more lending. Ram reports another sale. GDP goes up. Everyone says the economy is booming. But you know what's really happening. In 6 months, Mike defaults. Truck gets repoed. Bank takes a loss. Mike's credit is destroyed. That growth was just debt dressed up as prosperity. That's what Buffett sees in this 4.3% number. Borrowed money showing up as good news on TV. Now let me show you 3 numbers that Buffett is looking at that don't make the White House press releases. And the first one should make your blood run cold. The U.S. government is now paying $970 billion per year just in interest on the national debt. Not paying down the debt, just interest. According to the Treasury Department's own data from fiscal year 2025, we're spending nearly $1 trillion a year just to service what we owe. That's more than we spend on defense, more than education, transportation, and veterans combined. Just interest. Here's what that means in real terms. That's $7,300 for every household in America, every single year. Money that could fix roads, lower your taxes, or actually fund Social Security. Instead, it's going to bondholders. And here's the part buried in footnote 47 of the Treasury's monthly statement that nobody reads. If interest rates rise just 2 more percentage points, that annual interest bill jumps to $1.6 trillion. That's $12,000 per household, every year, forever. Buffett read footnote 47. The question is, did your financial advisor? Because here's what happens when you're paying $1 trillion in interest while borrowing more to create GDP growth. You're on a treadmill that's speeding up. Eventually, you can't keep running. Second number. American households are carrying $17.9 trillion in total debt right now. That's according to the New York Fed's Q3 2024 report. Credit cards, auto loans, mortgages, student loans, everything. Let me introduce you to Sarah. Single mom, Denver. Dental hygienist making $52,000 a year. She got $8,200 on her credit cards at 27% interest. She's not irresponsible. Her car broke down. Her kid needed braces. Rent went up $300. Life happened. Sarah's part of a $17.9 trillion problem. And according to the New York Fed, credit card delinquencies just hit 3.1%, levels we haven't seen in over a decade. Auto loans are spiking too. This is happening while the economy is supposedly booming at 4.3%. What does that tell you? Real Americans aren't experiencing a boom. Sarah isn't celebrating 4.3% growth. She's choosing between making her minimum payment and buying groceries. The GDP number says growth. The debt number says drowning. One of them is lying. Third number. Corporate profits are at near record levels as a percentage of GDP. Companies are printing money. But here's the question Buffett always asks. How? Are they selling more because people have more money? Or are they just charging more while people have less? Your grocery bill tells you the answer. Same cart of food that cost you $140 in 2019 now costs $215. That extra $75, that's not inflation. That's corporate profit. They didn't improve the product. They didn't add value. They just raised prices because they could. Kroger's profit margin in 2019, 1.8%. Today, 3.2%. You're paying for that difference. And according to the Bureau of Labor Statistics, your wages haven't kept up. Real wages, adjusted for inflation, are still below where they were in 2019 for most workers. So companies make record profits by charging you more while paying you the same. That shows up in GDP as growth. But it's not sustainable. Eventually you run out of money. You stop buying. They stop profiting. The whole thing collapses. Buffett has seen this before. Twice. In 1999, everyone was celebrating dot-com boom. Internet stocks going vertical. Everyone's getting rich. Buffett sat out, held cash. People mocked him on CNBC. Buffett doesn't get it. He's old. He doesn't understand the new economy. March 2000. Bubble burst. NASDAQ fell 78% over 2 years. Trillions evaporated. People lost everything. Buffett lost nothing. He had cash. And he bought great companies at garage sale prices. 2007. Same thing. Economy growing. Housing prices soaring. Financial companies reporting record profits. Everyone's winning. Buffett started building cash, pulling back from deals. People asked why. Don't you see the growth? Don't you see the profits? And Buffett said in his 2001 shareholder letter, "Only when the tide goes out do you discover who's been swimming naked." 2008. Tide went out. Banks collapsed. Stock market fell 57%. Worst recession since the Depression. Buffett had $44 billion in cash. He deployed it into Goldman Sachs, Bank of America, other blue chips at crisis prices. Made Berkshire tens of billions. Now it's 2025. Official numbers say strong economy. 4.3% growth. Record stock prices. Everyone's bullish. And Buffett is holding $381 billion, 9 times more than 2008. History doesn't repeat. But it rhymes. And right now, it's rhyming loud. So here's what this means for you. And this is where it gets personal. Remember Tom Richardson? 58 years old, electrician in Phoenix, makes $72,000 a year, has $340,000 in his 401k, plans to retire at 65. Tom thinks he's done everything right. He's been saving since he was 30. He's got a decent nest egg. He watches the news celebrating 4.3% growth and thinks, 7 more years and I'm out. But if Buffett is right, Tom's retirement just got delayed or canceled. Here's the math. If this artificial growth collapses and the market drops 35%, which is less than it fell in 2008, Tom's $340,000 becomes $221,000. He just lost $119,000 in purchasing power. But it gets worse. Tom is 58. He doesn't have 20 years to wait for recovery. If the crash happens when he's 62 and takes 3 years to recover, he's 65 with a portfolio that's still down. He can't retire. He's working until 70, maybe 72. That's not a story. That's the math of what happens when you're fully invested at the peak and you're close to retirement. And here's the brutal part Tom doesn't see coming. When the crash happens and he panics and sells at the bottom to stop the bleeding, Buffett will be buying what Tom is selling. Tom's fear becomes Buffett's profit. Tom sells Apple at $140 in a panic. Buffett buys it at $140 knowing it'll be $280 in 5 years. The wealth transfers from the scared to the prepared. This is what Buffett means by be fearful when others are greedy and greedy when others are fearful. Right now, everyone's greedy. So Buffett is fearful. He's holding $381 billion in cash. When the crash comes and everyone's fearful, he'll get greedy. He'll deploy that cash at prices that'll make him billions, while Tom is trying to figure out if he can afford to retire at all. So what do? Here's exactly what this positioning tells you to consider doing. Not next month, this week. Monday. Log into your 401k right now. Look at your allocation. If you're over 50 years old and more than 70% stocks, you're overexposed. You're taking more risk than you can afford. When the market drops 35%, can you wait 3 years without selling? If the answer is no, you need more defensive positioning. Tuesday. List every debt you have. Credit cards, car loans, everything. Anything charging more than 8% interest is enemy number one. That needs to be paid off before you invest another dollar. Because when recession hits, that debt becomes a noose. Wednesday. Calculate 6 months of expenses. Rent, food, insurance, everything. If you don't have that sitting in a savings account, not invested actual cash, that's your first goal. Buffett can sit on $381 billion and wait. You need at least 6 months of cushion. That's it. 3 days, 3 actions. This isn't complicated. It's just math. Because here's the difference between you and Buffett. He can afford to be wrong. If the economy keeps growing and stocks keep going up, Buffett just misses some gains. Berkshire is fine. He's fine. But if you're fully invested because your advisor said stay the course, and the headline said 4.3% growth, and Buffett is right, you could lose 35% of your retirement. If you're 60 years old with $400,000, that's $140,000 gone. That's not a mistake you recover from. The risk is asymmetric. Being cautious like Buffett costs you potential gains. Being fully invested at the peak could cost you your retirement. Here's what nobody wants to say out loud but needs to be said. The White House is celebrating 4.3% GDP growth in press conferences. You know what they're not celebrating? Real wages still below 2019 levels. Record consumer debt. $1 trillion in annual interest payments. They're popping champagne while Sarah in Denver is choosing between her credit card payment and her electric bill. They're telling you to believe the economy is booming while you're watching your grocery bill go up every single week. One of two things is true. Either every economist in Washington is right and the 94-year-old man who's been right for 70 years is suddenly wrong. Or the people with a job to make numbers look good are making numbers look good. Buffett doesn't have that job. His job is making money. And he makes money by seeing reality, not spin. He sees an economy running on government debt that's exploding, consumer debt that's defaulting, and corporate profits that are squeezing consumers who are running out of money. That's not sustainable. That's a treadmill speeding up. So he's holding $381 billion in cash. Not because he's bearish on America long term. He says all the time you should never bet against America. But because he's bearish on current prices relative to current reality. The 4.3% GDP number is a press release. Buffett's $381 billion is an action. One is words, one is money. And in investing, money always speaks louder than words. Look, maybe Buffett's wrong this time. Maybe the economy really is as strong as they say. Maybe debt doesn't matter anymore. Maybe consumers can keep borrowing forever. Maybe companies can keep raising prices while wages stay flat. Maybe. But Buffett's bet says otherwise. And his track record says pay attention. You don't have to sell everything. You don't have to panic. But you should ask yourself, what does the smartest investor in history see that I don't? The economy might be growing at 4.3%. But Buffett is preparing for what comes after the growth stops. And based on 70 years of being right when everyone else was wrong, preparation might be the smartest move you make. If this helped you see the gap between the headlines and the reality, hit that like button right now. I track Buffett's moves every quarter and break down exactly what they mean for your money. Subscribe so you don't miss the next warning sign. Thank you for watching. Verify everything through your own research Consult with licensed professionals and understand that all analysis involves uncertainty. Your financial security is too important to trust anyone blindly.